Candlesticks come in all shapes and sizes. They are used as a component within technical analysis, and one of them is the bullish hammer. This specific candlestick pattern mainly proves its usefulness in active swing trading strategies in which the pattern is used as a warning signal that an existing bearish trend might be reversing. By combining this pattern with other candlesticks before and after the bullish hammer itself, even real reversal signals arise, consisting of several consecutive candlesticks, which benefits the reliability of the signal. In this video, what is a bullish hammer pattern, the interpretation of the hammer candle, using the pattern in a real trade setup, finding bullish hammer candlesticks with a stock screener like ChartMill, and then to finalize the key elements to remember. My name is Christoph. Welcome to ChartMill. The hammer pattern consists of a small body. The color is less important. However, a typical feature is the long shadow at the bottom, which is at least twice the size of the actual body. To qualify as a real hammer pattern, there should be no top shadow. In common practice, however, patterns with a very small upper shadow are also considered hammer patterns. If we start from the daily time frame, the formation of the candle can be described as follows. At the start of the trading day, there is a sharp decline and sellers have the upper hand. Initially, we see the formation of a red bearish candle as a result. At some point, however, buyers enter the market and push the price up again, creating the typical undershadow. The closing price ends up being relatively close to or above the opening price. The fact that buyers were able to completely wipe out the initial decline is an indication that the downward momentum is losing strength, which can be interpreted as a harbinger of a trend reversal. Now, this assumption is based on one candle only, which makes its trustworthiness low. And that's why we should at most consider the candle itself as an early warning signal if it occurs after a confirmed downtrend. Depending on the type of candles visible before and after the bullish hammer, there could be a real reversal pattern. The first requirement for this is that the bullish hammer occurs after a clear price drop. And this is an example where the bullish hammer only became visible after a price retracement in an ongoing uptrend. The candle which follows the bullish hammer serves as a confirmation signal. A long white candle, which means that after the opening of the market, the price immediately rose strongly and finally could close just below or even at the high of day. And this is a confirmation of the earliest buyer's momentum of the day before, when the bullish hammer was formed. This combination of candlesticks with the bullish hammer in the middle is a strong reversal pattern, especially when this pattern is visible on a significant support level like the SMA 200. It offers opportunities to enter the market with relatively little risk and to speculate on a trend change. When opening a position based on the bullish hammer candlestick pattern, there are some things to consider. It is very important to wait until the bullish hammer candle is confirmed by a third bullish candle, the confirmation candle. It is tempting to open a position immediately after the bullish hammer, but the reliability of that candle alone is just too low. Especially with a stop loss just below the candle, you'll be stopped out in many cases. Place your order only after the market has closed, and use a stop order by which you determine that you want to buy the share the next day as soon as the price goes a few ticks higher than the high of the last candle. In case you still have doubts, protecting your trading capital should always be your main concern. A hard stop loss is the best way to protect yourself if the position does go the wrong way. Place the stop loss below the most recent swing low. As soon as the price falls below this level, the setup is no longer valid and the position must be closed. Make sure you put the stop loss at least a few ticks below the recent low. In some cases, a double bottom will be formed first, and a few ticks can then sometimes be just enough to avoid being stopped out. As soon as the position moves in the desired direction, you need to determine where and when you are going to sell the position. There are various ways of doing so, but it is always advisable to take into account the price levels which you know could be potential resistance. In this way, we have determined the first target for this position. If that first target is reached, there are several options available. Raising the stop loss to the break-even level is one of them. This will at least give you the certainty that this position will no longer cause you any loss. If you choose to manage the position in several parts, you can sell a small part of it and hold on for the rest with the intention to profit from a possible bigger trend movement. In the example, you notice that there was indeed price collusion at the first target level. Once the price broke out upwards, the stop loss for the remaining position can be placed below that sideways range. By doing so, you've secured a profit for the remaining part of your position. This is another example on the weekly chart for Vertex Pharmaceuticals. The overall long-term trend was clearly bullish since the beginning of 2022. And after a clean retracement between April and the first week of May, the ChartMill trend indicator served as support and a bullish hammer reversal pattern was formed. Bullish hammer candlestick patterns occur frequently on the charts, but to find the patterns that meet some basic criteria, it is best to use a stock screener like ChartMill. This allows you to work much faster and more efficiently and not waste time manually searching through numerous charts. The candlestick filter can be found on the stock screener page under the menu Indicators. Open the Candlesticks section and select the bullish hammer pattern from the drop-down menu. For this pattern, a predefined trading screen already exists in our Trading Ideas section, and you can use this filter directly or supplement it with your own specific filters. And I'll put a link to the specific trading idea in the description of this video. This specific candlestick must be preceded by a downtrend or at least a temporary price decline in a long-term uptrend to be recognized as a bullish hammer. As such, it is an early warning signal that an existing downtrend may be losing momentum. The most important part is the lower shadow of the candle, ideally at least twice the size of the body. The color of the body is less important. It should be a small anyway, so it doesn't matter if it closes slightly below or above the opening price. Always keep in mind that the candlestick itself is not sufficiently reliable to open a position against the prevailing trend. Always wait for confirmation of a third bullish candle and also take into account other elements on the chart that further strengthen the signal, a double bottom, retracement on moving average, etc. Now, if this pattern is seen after a strong upward trend, it is considered as a hanging man candlestick pattern, making it rather a bearish warning signal. Take a look at the chart of Berkshire Hathaway, for example. At the end of March 2022, a hanging man reversal pattern became visible after a strong upward trend. This pattern was the beginning of the current long-term downward trend. So, if you like this video, please give it a thumbs up, and if you're not yet subscribed to the channel, please do so. Thanks for watching. Trade safe.